Welcome back, everyone. In this episode, we're going to be going over earnings season. It's kicking off. In fact, we have a couple of companies that just reported earnings. We're going to go over those. Then we're going to look at the map of the upcoming earnings reports. We have a lot of companies here. I went through and I highlighted, I circled them in red. Which ones I think are the most notable? I think most of the investors are paying attention to. We have companies like Johnson & Johnson that's going to report earnings tomorrow morning. Goldman Sachs is another big bank. We had Bank of America and JP Morgan already report earnings. I'll give my thoughts on those. We have Netflix Tuesday after close reporting earnings. Big one right there. A lot of investors pay attention to that one. Netflix is a big holding of mine, so I'll give you my thoughts on that one. Ally Financial. It's a very popular bank, fintech company, financial company that a lot of retail investors own. I have looked at that one for a long time. It's on my watch list, so I'll give you my thoughts on that as well. IBM, this one's making a bit of a comeback, so we'll look at that one. And then, of course, we have Tesla. Tesla. We have a lot of Tesla investors disappointed about how the year's gone, with the stock down around 40% or more, and they're wanting to have buybacks. So I'm going to go over my thoughts on the buyback plan for Tesla and how I think that would work. Then we have Snapchat, another one that I think is important. This company has horrible financials, but it's growing right now. And then American Express. So we're going to go over all of these. I'll give you my thoughts on them. I think it'll be a fun video. And I want to talk about earnings in general. Now, before we jump into that, just a quick update on the Story Fund. If you're new to the channel, this is something that I try to do routinely, is give updates on my portfolio. One of my portfolios is called the Story Fund. The Story Fund is investments into highly scalable growth companies that I think have immense amount of potential. So my goal here isn't to try to do these timely trades in and out of companies as they go up 20 or 30%. The goal here is to buy pretty reasonable stakes in the companies that I think have the potential to compound for the next 5 to 10 years, to really grow substantially. So I have a lot of these technology-driven, highly scalable growth companies that are typically market leaders. Now, so far this portfolio, it's just been crushed. It's been smoked. I invested at the wrong time. I bought in heavily in 2021. It hasn't done well. I've benchmarked this against the S&P 500. And like you can see here, it's not fun to show, but we're getting smoked right now. We're not doing so well. The Story Fund is in blue and the S&P 500 is in red. So they're both doing pretty bad. The S&P 500, as we've seen over the past year, taken a massive dip. It's down 7% now. Story Fund's down 23%. What I will say is I feel very good about the holdings in terms of I'm holding very good companies that I think can make these losses back. And I actually think they can do it very quickly. So I have no leverage. I have no time constraints. I've bought into these companies with money I don't need for a very long period of time. So I'm okay just letting this money sit here in these companies, letting them grow and let them go through multiple earnings season. So hopefully they can show their value. My biggest bets are on Amazon, Netflix, and Google. Those are the three biggest right now. After that, we get into this mid-tier: Microsoft, Adobe, Salesforce, and Apple. And Apple and Crocs are the only ones in the green right now. So this whole portfolio has done terribly. Ironically, I have another portfolio that is far more conservative. It's a dividend growth portfolio, and it's doing a lot better than this one. It's actually benchmarking much better against the S&P 500. But regardless, that's what's happened with my portfolio. Let's go ahead and jump into this earnings news. Now, before we get into these individual upcoming earnings reports, I want to go over the predictions of the earnings season in general, the earnings apocalypse. This right here, this prediction by Michael Burry and many other notable bears, the earnings apocalypse means that all these companies are going to disappoint. Across the board, they're going to say, look, we said we're going to earn this much money and we're not going to. We have to revise our earnings downwards, a downward revision because of XYZ. We have worse margin pressure. We have input costs. Our labor costs have gone up. For different reasons, our earnings are going to be worse than expected. If earnings are worse than expected, then on the PE ratio of companies, the E goes down. So companies on a price to earnings basis look more expensive, and therefore the stock market goes down. And many notable bears, again, like Michael Burry and others, are saying this is the next leg down for the stock market. This is what will drag it down another 20%. This is what Greg Jensen of Bridgewater predicted will be the next 15 to 20% downward. Earnings revisions downwards, causing the market to go down. But that hasn't been the case so far. So far, Burry and Greg Jensen and the bears have not been proven correct with this prediction. They say 35 companies have reported third quarter earnings so far. Out of that group, 68.5% have beaten estimates, lower than the prior 4-year quarter average. That was a very high average, though, of 78%, but higher than the historical average of 66.2%. So the companies so far, the 35 that have reported earnings, they've reported earnings that have beaten estimates at a higher rate than the long-term historical average. So far, this earnings season is doing fine. Then 2 of the biggest companies, JP Morgan, they reported earnings and they beat earnings. They beat both on revenue, their EPS. They're holding back more money for loan losses, potential loan losses in the future. So they're being super conservative, but they beat earnings. That's why they're doing so well. We can also look at Bank of America that just reported earnings. And right here, we have a note that says Bank of America shares are trading higher after the company reported better than expected Q3 earnings per share and revenue results. So Bank of America also beat estimates. It's up 5.4%. That's a big holding from Buffett. So this article basically outlines that as of right now, the bears saying the earnings apocalypse is going to happen, they haven't been proven correct quite yet. They might in the future, but not right now. Now let's go ahead and look at these and what I've outlined as companies to look at. The banks are important, and we've seen from 2 major banks right now that have both done really well. JP Morgan and Bank of America did better than expected. That is good news because they represent the U.S. economy. They have deposits from millions of people. So the fact that they're still earning money, they're still lending money is a good thing. We have Goldman Sachs tomorrow. This is Tuesday before open. My prediction is they'll beat estimates. I think they'll do it with their trading. I think they'll do it because JP Morgan did as well. That's my guess. Don't trade off of it. It's not financial advice, but that is just my estimate. Johnson & Johnson's the other one that's reporting earnings tomorrow morning. This is one that's a dividend investor's favorite. I don't have any exposure directly to Johnson & Johnson. I think the company is a great company. It's been around for a long time. It's paid dividends for like 100 years. Look at this dividend growth. There's not many companies like this in the market. It's one of the very few. It goes back to 1962. We have all the data there to see the dividend growth. And even in the past decade, they've grown up by 6.3%. Just remarkable. This company's amazing, but it's spinning off. And I'm most interested in the retail portion of Johnson & Johnson after the spinoff. They're consumer good products. But right now, they have a lot of lawsuits and a lot of things that they're facing that makes me not so eager to jump into it. So I'm not in this one right now. If I had a guess, I think that Johnson & Johnson will do just fine. It's a very slow compounder, very predictable company, heavily diversified, has very defensive products. I don't think they're going to do terrible. It'd be surprising if they did. The one that is less predictable than Johnson & Johnson, even Goldman Sachs, in my opinion, is Netflix. Let's talk about Netflix here for a minute. Netflix is one of my bigger holdings in the Story Fund, and so far it's performed terribly. In fact, it's my worst investment I've ever made at any point in my life. This is it. You're seeing the absolute worst right here. Netflix. I have $15,000 of value, and I'm down $15,000. So it was a decent amount of money put into it. It got chopped in half by 50%. I have an investment thesis on this company. I've gone through and explained it before. I think the company in 2026 will have an earnings per share of around $33. I assumed it would be trading in the mid-20s multiple, around 25, which would give it a stock price of around $850. So much higher than today. And I still don't think those predictions are too unreasonable. Maybe the multiple won't be at a mid-20 ratio, but I still think the company can have decent earnings per share in 2026. So when I look at this company, let me go over a couple things here. First of all, Netflix it's reporting earnings Tuesday after close, and Netflix is one of the companies that I think is the most unpredictable in terms of their earnings report, the most difficult to predict. And that's by virtue of them being just a difficult to predict business in the short term, but also by virtue of the company being the first major tech company to report earnings. Every earnings season that comes around, we don't see Apple here. We don't see Microsoft. We don't see Amazon. We don't see Spotify. We don't see a lot of these companies. We see Netflix. Netflix is number one. And Netflix sets the tone. They go out first. They report their earnings, and they're the first tech company to do so. And if they get hit really hard, the market freaks out. They sell a bunch of Netflix and then they re-rate all the other tech companies. Because again, Netflix is the tone setter. They're the test dummy that goes out before all the other tech companies. So you saw that 3 earnings reports ago. Netflix went out and they reported horrible earnings. They lost subscribers when they were predicted to gain subscribers. The market freaked out. They traded Netflix down like 20%. And then all the other companies, the investors were a little bit more ready that this is going to be a tough earnings season. So they traded in advance of their earnings. So Netflix really has, I think, an unfavorable position of reporting their earnings first when it's far more volatile, unknown. Investors are a little bit more nervous than halfway through the earnings season when they've been accustomed to the earnings, when they have the temperature of the earnings, so to speak. So I think that's one part of it. And then Netflix is also becoming more difficult to predict as they get a bigger and bigger subscriber base. When you have 220 million subscribers, you have so many people coming and going all the time with new people joining, and then you have people leaving, you have churn, that I think it becomes more difficult for them to give their very specific projections. So overall, in my opinion, this is not a stock that you bank on it beating earnings or doing any specific thing in one earnings season. This is a stock where you try to look 10 years down the road and you just see how you think things are going to unfold. In my opinion, when I look at Netflix 10 years down the road, the reason that I still hold this company, despite it being down 50%, is I still have that long-term vision of where this company is going to be. I think Netflix is the biggest scaled leader in streaming. I think they have the largest breadth of content for both children, adults, teenagers, everybody. I think they have an immense amount of content. And a lot of their stuff that they've been putting out recently, in my opinion, is not so bad. I think a lot of their content's great, even though it's not Game of Thrones, Rings of Power, it's not Mandalorian. They have a lot of that in-between content that I think is pretty good. When I bring this up here, let's take a look at this company. Netflix is one, it's up 7% today. Again, volatile. Not even earnings today, and it's up 7%. So very volatile company. But you see right here, the price to earnings trades at an 18. This is lower than I think it deserves. I think investors are wary right now, which is fine. But I always thought a company growing this quickly, at least previously, should trade in the mid-20s. That's where I put the price to earnings multiple. The free cash flow yield right now is 0.15%. It's gone from the negative now to being flat, 0.15%. Seems very low, but the way that I look at this company, you notice, I'll switch to annual here so you can see the trend. Notice how it was going heavily negative every single year, more and more negative, and then it quickly swung to the positive in 2020. That is operating leverage. Netflix has a massive amount of operating leverage, which means when they get to a certain scale, they can just make a couple decisions. We'll just cut our content budget slightly, and then we have huge margins in between. That is a massive amount of operating leverage, and the bigger Netflix grows, the bigger this leverage is. So they can swing their free cash flow into the positive by simply doing budget cuts and by having the same amount of subscribers or incrementally increasing prices a little bit. My projections are what I think is going to happen over the next 2 years. I think this year, 2022, Netflix will have around $1 billion of free cash flow. Real free cash flow for the company. I think next year, in 2023, they'll post around $2 billion of free cash flow, which means that right now, based on a $100 billion market cap, based off of next year's free cash flow, it's around a 2% free cash flow yield, which isn't terrible. Look at a lot of high quality companies in the market. They're around 2 to 3%. So I don't think that Netflix is that expensive right now based on my estimates on a free cash flow yield or on a PE ratio. I think it's pretty cheap on both. The market trades at a 17 forward PE. Netflix is at an 18. And if they can continue to grow, I think there's a lot of upside for the company. So I'm staying invested in it. I have no predictions over the next this Tuesday. I have no predictions on what direction it's going to go. I don't have a clue. If you're looking to me to determine what direction Netflix is going to trade, don't have a clue in the short term. The other thing I'll mention is I think the focus for Netflix is moving less on subscribers gained and subscribers lost in one quarter to overall the margins and revenue and operating efficiency of the business. Investors might be focusing more on the ads than the subscribers this quarter. Netflix there's a lot of things where they started off and they said, we're going to have the ad tear next year, mid 2023. But now They say that it's expected to happen before year's end. And on October 13th, the streamer confirmed a November launch. They're launching the ad tier next month. How did they put this together that fast? I'm not sure. I don't know how they put together an ad tier that fast. They're expected to have around 5 minutes of ads per 1 hour of content. The ad tier is going to be $7 per month. It's proven to work. Disney's made it work. HBO's made it work. Lots of people watch hours and hours of Netflix. It's the most engaged platform in terms of viewership. So ads are based off of how long you view, not of monthly fees. The fact that people watch Netflix for longer periods of time than other streaming networks means that they're likely to earn more ad revenue than HBO or Disney Plus. Because again, you only earn money with ads if people are watching, not if they're just paying. They have to watch. They have to be engaged. So I think this will be a positive thing for Netflix. So I'm invested in the company. I'm going to stay invested. I said I was going to be invested in this company for 5 to 10 years, and that remains the plan. I still don't have a reason to change so far. And in terms of the losses right now, I think I have a good chance of making it back. I know it doesn't seem like that right now, being down this much, but Netflix has dropped 50% in value multiple times throughout its history. It's not something that's very uncommon. So I think this could be another time. One last thing I'll mention on Netflix, just as a side note, I've watched 2 episodes of this series, The Watcher, and it is super creepy. It's pretty good in my opinion. So if you want to watch a creepy Halloween show, turn on The Watcher. It was just released on the 13th. So it's a fun one to look at. Now, let's go ahead and move on. Ally Financial. This is one that I get asked about a lot in specific to my dividend portfolio. Let's go ahead and bring up Ally here. They report earnings before open on Wednesday. Ally is a really good dividend paying stock. Let me just say that. This company has a market cap of $9 billion, so it's a relatively small bank. And the big thing that draws dividend investors is this very, very fat dividend yield, 4.1%. Very good dividend yield with a low payout ratio. And then the best thing is they're growing their dividend very quickly. Over the past 2 years, they've averaged a CAGR of 25%. Very fast dividend growth. Going from 19 cents to 30 cents. Crazy. They're doubling the dividend over a couple years. Over the past 5 years, they've done a 20% dividend growth per year. Just remarkable. So that right there draws in a lot of people. I don't blame dividend investors for jumping into this company. I think it's a good product. I use Ally Financial. I think it's a good bank. I like investing in companies where I know the product's good, the customer service is good, or they get the tech down. I think for their bank, they have very good tech. It's very easy interface to use and a good app. So I like the product. I like the company. I don't think that it's expensive. The one concern I have about this company is stuff that you won't see just looking at the base level of financials. If you actually read about what the company does and you dive into what their exposure is, really when you're investing in a bank, you're investing in the loans that they give out. You have to read to what they're exposed to. And Ally Financial has made all of their money, their biggest source of revenue and huge source of profits. The huge majority of the profits of this bank is auto loans. And think about the auto market. Think about the used car market. It raced up to crazy amounts. People are paying way over book value, way over sticker price for the car, and now the market's kind of crashed. Used car prices are going down every single month. People are underwater in their used cars. A lot of people took out huge loans that they probably don't want anymore. And the way that a lot of people get out of loans, especially for cars that they're underwater in, is they ditch them. It's not probably the right thing to do, but they just ditch them and they leave companies like Ally Financial holding that vehicle where Ally Financial has to repossess it. That's expensive. They have to sell it on a secondary market as a repossessed car, and they take a loss on it. So they do have collateral. They can repossess the car. They can do that quickly and turn it over, but there's losses with that. And I don't know how big those losses are going to be. But if the car market, the used car market tanks like crazy, that's a lot of exposure to a market that I don't really want exposure to. So that's my biggest reservation investing in Ally Financial. I don't really like what they're exposed to right now. In terms of this upcoming earnings report, Wednesday morning before market open, I think you'll be fine. I think if you're invested in Ally Financial, I think this earnings report's going to beat. That's my opinion of it. But I think going forward over the next 3 months, I feel like it's a little bit more risky. I don't want to be in this stock. So I'm focusing on companies where I feel like there's just less exposure to things like that are up in the air. I don't like exposure to the housing market right now. I don't like exposure to the auto market right now. I think prices went up way too much. They're going to come down. Ally Financial stands to be one of the companies that takes on a lot of losses if that's the case. Now, moving on, we have to talk about easily the most anticipated earnings report of the week, which is Tesla. Tesla is reporting Wednesday after market close. Let's go ahead and bring up Tesla on Qualtrim Insights. If you don't know, this website is included as part of the Patreon. I think it's the best stock analysis tool. It gives you all the fundamental data on one page. Now, Tesla is a company that a lot of retail investors are drawn to, obviously because of the eccentric leader of the company, the crazy volatile stock, and the enormous gains it's had over the past couple of years. Tesla is up 755% over the past 5 years, but year to date, so far in 2022, it has not done well. It's down 49% year to date. It's had a really tough year, and Tesla investors, I think, are becoming impatient because if we actually zoom out a little bit, for the past 2 years, it's up 43%, but it's starting to look kind of like Amazon, where it went up to $300 and then it went up a little bit more and then it went down and now it's down a bit, and it basically hasn't moved over the past couple of years. And that just gets frustrating after a while when you see all the fundamental developments of the company. So Tesla investors, I think, are becoming a bit impatient. What I see online on Twitter, and I see the new talking point from Tesla bulls and Tesla investors, is buybacks. That's the new thing, is Tesla investors are wanting Tesla to announce buybacks in this upcoming earnings as a way to bump up the stock after the recent slump in price. So this is something that I think is different. Tesla is a highly innovative company, and buybacks are a way of using free cash flow to financially engineer the stock by buying back shares outstanding. So basically, all a buyback is, the company issues shares. This is the opposite of a buyback. They do this to raise capital, to pay for developers and employees. And a buyback's the complete opposite. They buy back the shares that they previously issued, which lowers the amount of shares outstanding, increases your equity in the company, and improves the price to earnings ratio. Now, the problem for Tesla, let me just say this. Buybacks require cash flow. They require real free cash flow and a lot of it. Buybacks, I think, are great. In fact, when I look at different companies, like let me think of one here. I look at Ulta. This is a company that I outlined as, I think, a wonderful investment, a really good compounder. It has a ton of free cash flow. Look at the free cash flow this company generates every year. $800 million of free cash flow for a company that's $20 billion market cap. A lot of free cash flow. And what do they do with that? They buy back their shares outstanding, which raises their price to earnings. So this is a company that has so much cash they can just continually buy back their shares, bumping up the stock price, raising the price to earnings. The issue with Tesla is it's a very, very large company, even after this sell-off. A $640 billion market cap. Just a couple of days ago, it was $700 billion. That's a massive company. When you talk about a company this big, the amount of money that you need to do buybacks that are meaningful is massive. And again, the problem with Tesla is they don't have a massive amount of free cash flow quite yet. The company last year posted $3.4 billion in free cash flow. $3.4 billion in all of 2021 for a company that's $642 billion in market cap. So they could buy back 0.5% of their shares outstanding with 2021's free cash flow. Even assuming in 2022 they do $5 billion, again, that's less than 1% of their shares outstanding. 1% free cash flow yield. They can't buy back a lot of shares. And Tesla routinely trades 7 or 8% in a day. So basically what investors are saying is use all of 2021's or all of 2022's free cash flow to buy back what amounts to just a tiny hour of trading. The stock is up 7% today, and a whole year of free cash flow could buy back 1% of shares outstanding. If they have an amazing year, they might be able to buy back 1.5%, maybe even 2%. But again, that's not enough to really move the needle for a company like Tesla. So what this company would have to do to really do meaningful amounts of buybacks, to buy back 4 to 6% of the stock, to really buy back a chunk of it, is they'd have to issue debt. You'd have to see this number, the actual quarterly debt, go up and their cash go down. So they could do that. They could use their free cash flow, but then also chunk away at their cash balance and increase the amount of debt they have and fund 10 billion or 20 billion or 30 billion of buybacks. That's an option for Tesla. I won't say if that's the best thing or the worst thing. In my opinion, I don't really love it when companies decide that the only way they can get their stock to go up is by taking out more and more debt and funding buybacks. I prefer companies that can do buybacks with their free cash flow without layering on more and more debt. There's some companies that I've actually sold out of because they bought back so much shares with debt that their debt just grew to a huge amount. Domino's is one of those. So in my opinion, with Tesla, I don't know what their earnings are going to be this season, but I think that investors are looking for the buybacks. They're looking for a way to bump up the stock because unless Tesla blows away their expectations, they're going to need some sort of financial help. And I think the trouble investors are finding themselves in is they have limited cash, they have limited free cash flow for the size of the market cap. Big company that doesn't produce quite enough free cash flow yet, but we'll see. I think there's a decent chance that Elon Musk will announce some form of buybacks to help pump the stock. Next up, we have IBM. This is a company that not many people are excited about. It's one of those older boomer tech stocks, right? That's been around for a long period of time, but they're actually doing better than expected. IBM has all their legacy clients that are very attached to the company. Plus they bought Red Hat and they're moving along with cloud. And I think they're actually doing better than expected. And that is the story of IBM. They have their earnings report coming up. Let's see, it's coming up after close on Wednesday, the same day as Tesla. So we'll see IBM right then. And the company trades at a 12 forward PE ratio, 12 forward PE. That is basically a commodity PE ratio, assuming an 8% cost of capital. A commodity PE ratio means that investors do not expect for the next 10 years for this company to actually generate any type of returns. They basically think that it's borrowing money to reinvest the money at the same rate that it borrowed it. So it's not actually creating any value, which means for IBM investors, if this company does anything better than expected, if it creates any value over the next 10 years, the multiple should expand, the company should grow its earnings, and they should make money. So another way of saying this is IBM has such low expectations baked into the stock because of the past couple of years. These 7%, 6% ROCEs are so low that investors are pricing in no value creation, a complete treadmill where the company just borrows money and spends money and there's zero value created. And all IBM has to do, the only thing they have to accomplish is creating a little bit of value for the investor. If they can accomplish that, investors will make money buying at today's price. So in this upcoming earnings report, I'm going to make a prediction here. I think IBM will come in better than expected. Don't know for sure. Don't trade on it. I can't see the future, but that's my prediction. The company has been doing better recently. They've been on kind of a groove recently. They're down less in the market. I think they're going to do better than expected. And I think the company deserves a little bit higher than a commodity multiple of a 12 price to earnings. After that, we have Snapchat. This is a company that I've mocked many times in the past because of its horrible financials. I use it as an example on Qualtrim of the type of company that's really dangerous to invest in, and it has proven that over the past year. A year ago, I made a video, and I was ruthlessly mocking this company, Snapchat, saying that investors are paying way too crazy of a price. They don't generate any amount of money whatsoever, and all of the executives, the owners of the company, were selling out of the stock left and right. Not the type of company to get into, in my opinion. But the stock is now down 79% year to date, and when I look at this, it suffers from the same problem. It's growing revenue, which is great. Snapchat's one of the few that's actually growing the user base, which is really important. So they're having actual organic growth with the company's reach. But we have negative EBITDA. We have the free cash flow moving positive over time, which is good to see. The net income's still negative. The earnings per share is still negative. There's growing amounts of debt. I guess they have more cash than debt right now, so that's not really a problem. And they're still doing dilution. And right now, executives of the company are still selling out of the company. The ROCE of the company, which is the returns it's getting on invested capital, it's negative, but it's becoming less bad over time. So you see the trend there. The idea is if you invest right now, they'll start having positive returns in the future, and the company will actually start generating wealth for the shareholder. Now, I haven't studied this company in depth, but based off of what I see right now, for me, it's still an avoid. I have no interest in going into it. I think social media networks are dangerous to invest in anyway. Messengers are dangerous to invest in. I'd rather have a more stable product. And with the financials of a company like this, there's no way I'm touching it. I would not be surprised if Snapchat just tanked after earnings. If they have any bad news with a company that's losing money like this, I think there's a lot of downside with it. So this one I think is extremely risky. The last one that I highlighted is American Express, which is reporting earnings Friday after or before market opens. So Friday before open. The reason I circled American Express is not because I find this company particularly interesting, but it's the first major payment processor like Visa or MasterCard to report earnings. And these type of companies are used as a proxy, a gauge for the US consumer and their spending habits. If they report terrible earnings and they say that consumers are no longer spending, all their spending is going to low ticket items, they have huge credit card balances and they can't pay them off, and our earnings are, they're not doing well, that's a problem. If they report that, then investors will become very scared. I don't think they're going to report that because we've already had some earnings from Bank of America and JP Morgan that give us a little bit of insight into the consumer already. So if I had a guess with American Express, I think this one will do well. I think based off of Bank of America, JP Morgan, the balance sheets of US consumers, we still have cash. The employment levels of US consumers, we still have jobs. And I think that US consumers are still spending money. So in my opinion, I think American Express will do just fine. I think they have done fine over the past 3 months. I think they're probably going to beat on their earnings. That'd be my prediction. So that's it. We have an exciting week ahead of us, and I'll be giving individual reactions and different videos based on companies that I think have either surprising or insightful earnings. I'll probably be reacting to Netflix, as that's a big company of mine, a very interesting one in my opinion. I'll also be doing a reaction to Ally Financial's earnings. I'll do that on the dividend channel. So we have a lot to cover. I'll even give my thoughts on Tesla's earnings and the whole buyback situation. So I'll be doing more reaction to these, but that's my thoughts so far. Hope you enjoyed the little look forward for this week. That's all for now.